Hey everybody, it's Daniel here from InfoRest. Hope you're all doing well. So pretty interesting day in the markets today. We see bonds rallying, stocks were selling off in the overnight session as the 10-year bond yield finally hit 5%, above 5%, causing shock waves in the overnight market. Stocks were selling off. Right, bonds were selling off, and then the North American session came, and at 9:30 a.m. we saw stocks kind of plunge quickly and reverse the whole move and went up all day, and same with bonds. Bonds basically rallied all throughout the whole day. And while this happened, and especially the 10-year yield, it's very interesting. We had a very big investor come out, make some comments about his bond trade, and that caused yields to basically come off quite significantly, and the bond prices to shoot up. So who am I talking about? Yes, it is Bill Ackman. Bill Ackman basically came out and warned that there's some economic risks that he sees, right? We know, and we've heard from Bill Ackman in the past basically come out and say that, hey, we expect that bond yields to possibly hit 6-7%, and he came out and also said that they're short U.S. Treasuries. So if you're short U.S. Treasuries, you're basically betting that the price of U.S. bonds are going to go down. That means higher yields. You expect higher yields down the road. Now, he came out and he basically said this, very interesting, after, telling everyone that, hey, higher yields are coming and we're short, and we see, the bond market plunging way more than what it is right now. And basically he comes out and he says there's too much risk in the world to remain short bonds at current long-term rates. The economy is slowing faster than recent data suggested, and therefore he got out of his short position. So Bill Ackman is no longer short. He basically covered and took profits off his position, basically because he believes that the economy is slowing faster than what the data is suggesting. In other words, what that basically means is he sees that bond prices to now move up, shoot up from here, and for those yields to basically come down. So, this recession theme is something that we've been talking quite a bit on this channel for some time. And yes, when, recession does come, when there is, fear in the markets, fear, uncertainty, doubt, if there's some sort of big black swan event, some sort of credit event, money will flock to the safe haven assets like bonds, and that's where you'll see bond prices go up and yields come down. Now, what is it that he sees now rather than, a couple of months back when he was saying yields were going to go higher? Basically, it's just that the economy deteriorating faster than, I guess, what the data is showing. What other information he knows, we'll find out and we'll see then, right? But yes, if you look at the commercial real estate, right, that's been always under question, and the whole regional bank crisis that happened early of this year, we saw a lot of the regional banks completely plunge. We see also from the bank earnings that these paper losses on the balance sheet, they're significant. Although, yes, the Fed came out and they did say that, these losses, we will just bring them back to par, so they're really not losses. We're basically backing you up on those bonds, so they're not losses because you're going to get your full money back, right? So, to add to all of that, with the higher yields that were going up, with the 10-year, the 30-year hitting the 5% and higher, that just puts more strain on more of the loans, the consumers out there, the businesses out there that have a lot of these loans, these debt products. And then we also heard recently auto delinquencies at record highs, right? We know that everyone's feeling the pain and the pinch, and we're seeing that, hey, these yields continue to go higher, which is creating more pain for people, especially when it comes to refinancing their mortgage. A lot of them have to renew their mortgage. And like for the commercial real estate, the expectation is that heading into next year, a lot of those refinancing and the renewals are going to come up, and what most people are going to do is hand those keys back to the bank and say, hey, I'm taking a loss on this, you take it, I'm not paying anymore, right? So there's many more things, right? We can't really predict what exactly is going to happen, but we can get a rough idea what might be the problem, and we could see the signs and effects. So when you hear Bill Ackman come out and saying that, hey, they're done shorting and we see risks, it's something to keep an eye out and see, okay, what is it exactly that's going to happen next. Another really important investor, also hedge fund guy, retired bond king, is basically Bill Gross. He says that he sees a recession in the fourth quarter this year, and this higher for longer mantra that a lot of people are saying that, hey, rates are going to stay high for a very long time, and you heard this from the Federal Reserve and from a lot of central banks out there. He says that's yesterday's mantra. So basically, there's also going to be an end to all of this higher for longer, and also, in other words, saying that you could see bond prices go up from here. So you got two big prominent investors out there coming out and saying that, yeah, bond prices can go up here. Right? Bond prices can go up higher now, and yields are probably going to come down lower. Right? So what did Bill Gross say? Bill Gross basically said, he tweeted these things on Twitter, or I should say, sorry, X. I'm so used to Twitter. So I'm just going to go with that and tweet and use the word tweet in Twitter. But anyways, he went on and he said, regional bank carnage and recent rise in auto delinquency to long-term historical highs indicate U.S. economy slowing significantly. And he pinpoints and says recession in fourth quarter. Best investments are equity ARBs. I'm seriously considering regional banks again. Then he says maybe next week we'll tweet on bonds. Invest in the curve. Various combinations, 2 10s, 2 5s, should go positive before the year end. And I'm buying SOFR futures. Higher for longer is yesterday's mantra. So basically, what is he saying here? He's saying that, hey, recession, regional bank carnage, and recent rise in the auto delinquencies are at historical highs. This is a problem. This doesn't look like it's going to end well. Probably recession in fourth quarter of this year, which means what? Flight to safety. Which means what? Bond prices higher. And when he tweeted and he said he will tweet and talk more about bonds next time, but he basically said invest in the curve, which is basically that yield curve, right? The 2 10s yield curve. Basically, it's in inverted territory right now, and what's happening is you're getting the steepening in the curve, which is causing the curve to get very close to normalizing, going above, and finally being above, being positive now, right? That curve. So what do I mean by that? I basically mean that, in simple words, is that for the yield curve to steepen, you'll need, basically, bond prices would go up on fears in a recession, and the short end yields would come down more aggressively than the long end, which causes that 210 curve to basically straighten out and steepen and go back into positive territory, right? So when he says invest in the curve, he's basically saying go long the 2-year, and if you're putting on a spread trade, you can short the long end, the 30-year on rallies, and go long the 2 years on dip, because he expects that rates are probably going to come down, especially if things are going to get worse off, right? The credit event, the big kaboom, the big recession event, right? Unemployment rate skyrocketing, etc., etc. With everything that's happening around the world, right? It's very possible that things could start to break. And that's why you have these two big investors come out saying that, hey, I think we're kind of done shorting bonds here. I think we got to look at bonds. We got to look at the curve. We got to looking at yields coming down, going long, right? Not because, hey, everything's fine, right? You might hear a lot of people say that, hey, don't worry, rates are going to come down very soon, and that mortgage is going to be better, and your refinancing, you don't have to worry about that, which is all great, but that means something, right? If rates have been going up aggressively to fight a hot economy, right, then cutting rates would basically mean that you're trying to save an economy that has been hammered hard from all the rate hikes, all the tightening that's been happening, because simply something broke in the system, right? That would be a reason to cut rates, especially where inflation is, right? You're not going to cut rates where, especially when inflation has not hit the 2% target, especially when you have war, especially when there's supply chain disruptions, especially between tensions between the West and the East, oil prices still higher up. There's still a lot of external factors out there that is keeping inflation up there, right? So, if you get the recession, you get the hard landing, then that should eventually feed into inflation, should eventually feed into unemployment rate going higher, which thus would bring lower rates, lower yields, higher bond prices, yield curve steepening. All right, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.